If you wait until December to do these 5 things, it might just cost you a lot of money in extra taxes paid. Every December, custodians or financial companies like Vanguard or Fidelity that hold your accounts get flooded with requests with year-end deadlines. And unfortunately, not all those requests are filled. I saw this firsthand when I just started in the business, when a client called in mid-December and asked to make a charitable distribution from their retirement accounts. Despite many calls to expedite this process, it wasn't completed until the new year. And that's why we tell clients November is the time to get things done. And if you wait, you risk missing out on many opportunities that expire at the end of the year. In 2024, if you're 50 or older, you have the ability to make catch-up contributions to your retirement accounts. For pre-tax accounts like 401ks or 403bs, you're allowed to contribute an additional $7,500 on top of the standard $23,000 limit. Now for IRAs, the catch-up contribution is an extra $1,000 above the $7,000 limit. So if you think that this year is going to be a high income year, or you're expecting a hefty end of the year bonus, then you might want to consider more of your November and December paycheck to these tax deferred accounts. You won't just increase your savings, you'll lower your taxes as well by contributing to these accounts. The next thing to think about is getting charitable. Giving to charity not only makes you feel good, it can be pretty great for your taxes too. And if you're over 70 and a half, you can make what's called a qualified charitable distribution, or QCD, directly from your IRA. And this is a way to donate to charity and bypass adding the donation to your taxable income. But even if you don't itemize your deductions, you can still donate appreciated assets like stocks, which can save you from capital gains taxes. So for instance, when you donate stock that has grown significantly in value, if you donate it to that charity, the charity can sell it tax-free while you avoid taxes on the gain. Just make sure you talk to the charity or financial advisor you work with and make sure everything's on track and processed correctly. Now, if you have investments in your portfolio in a non-retirement account, like a brokerage or trust account that has lost value this year, tax loss harvesting can turn those losses into a tax advantage. Here's how this works. You sell investments at a loss and thereby use the losses to offset gains from other investments. And you can even reduce up to $3,000 in ordinary income. This may save you a whole lot in taxes, but remember the wash sale rule, which prevents you from taking the loss if you purchase the same or similar investment within 30 days. So keep in mind that harvesting your losses today may hike your taxable gains in the future. And for this reason, it's usually only smart to harvest losses if you believe your tax rate will be lower in the future. If you find this video helpful so far, give this video a thumbs up and subscribe for more tips to make your retirement planning easier. And if you want to see a certain video topic, leave a comment below. Now, if you think your tax rate will be higher in retirement, you may want to consider converting some of your IRA funds to a Roth IRA. Now, you will pay taxes on the amount that you convert at your current rate, but you'll enjoy tax-free growth and withdrawals later. And again, it's important to note this does increase your taxable income, so it's important to look at the impact on your current tax bracket. Typically, you want to convert the amount to the top of your current tax bracket, but no further. Now, you may have heard of tax loss harvesting, but not many people talk about tax gain harvesting. When you invest in outside retirement accounts, like a brokerage or trust account, you're going to be taxed on the appreciation or gain when you sell the asset. Now, this is all based on the tax bracket in the year of the sale, but long-term capital gains are taxed at lower rates compared to ordinary income. What's more to consider is a married couple taking the standard deduction can have up to $123,250 in gross income and still pay 0% on capital gains, thus making tax gain harvesting a strong strategy to realize gains tax-free. And unlike tax loss harvesting, there's no wash sale rule. So you're free to sell and immediately rebuy to reset that cost basis. But be aware of this tactic because it competes with Roth conversions, for space in lower tax brackets, so use it strategically. So, doing these 5 things before November ends is a great way to make sure these strategies not only get done, but help you start next year on the right track. And doing these 5 things can maximize your tax efficiency and help set up for a more comfortable retirement. Over time, these small moves can add up to a lifetime of tax savings and potentially reduce your tax bill by tens, if not hundreds of thousands of dollars. So don't let these opportunities pass you by. And if you have any questions, feel free to reach out to me using the link below or use the comments. And I hope you all have a happy Thanksgiving, and I'll see you in the next video.